The real estate market is shifting faster than anyone expected. Prices are falling, risks are rising, and most buyers and investors are completely unprepared. In this video, we reveal the hidden dangers, the triggers behind the correction, and how you can protect yourself and even profit before it's too late. For years, the real estate market appeared untouchable. Houses appreciated steadily, mortgages remained accessible, and buying property seemed like a guaranteed path to wealth. For many, this perception created a comforting sense of security, a belief that homeownership was always a safe investment. People planned their lives around this stability, confident that the value of their homes would continue to rise year after year. The media reinforced this notion, reporting record highs and focusing on bullish trends while downplaying underlying risks. It was easy to believe that the market was invincible. Yet beneath this facade of stability, subtle shifts were quietly reshaping the market's foundation. Economic indicators, long-term trends, and even demographic changes hinted that something was amiss. A closer look at the dynamics of housing supply and demand reveals the cracks forming under the surface. Construction booms in certain areas created temporary surges in supply, but in many regions, housing stock remained limited while demand continued to climb. This imbalance quietly pushed prices upward, creating a bubble-like effect that few fully understood. The signs were there, but most people ignored them, lulled into a sense of complacency by years of uninterrupted growth. Consumer behavior also contributed to the illusion of stability. Low interest rates and easy financing encouraged more buyers to enter the market, often stretching their budgets to secure properties at high prices. Many households assumed that property values would always increase, justifying larger loans and higher monthly payments. Investors joined the frenzy, purchasing multiple properties with the expectation of flipping them for quick gains or generating consistent rental income. The market seemed unstoppable, and optimism became a self-fulfilling prophecy, masking the underlying fragility that was quietly building. Meanwhile, subtle economic shifts began to erode this perceived stability. Wage growth, while steady in certain sectors, failed to keep pace with skyrocketing property values. Inflationary pressures increased the cost of living, and many households found themselves allocating a larger portion of their income to housing expenses. These challenges were often overshadowed by the excitement of rising home prices, but they represented the early warning signs of a system under strain. For those paying close attention, the warning signals were clear. Growth without balance is rarely sustainable. Another crucial factor was the psychological impact of long-term market trends. When prices continuously rise, people begin to believe that this trend is permanent. Buyers convince themselves that missing out on a purchase today means paying far more tomorrow. Investors assume that the next deal will generate the same profits as the last. This mindset fosters overconfidence, leading to decisions that prioritize short-term gains over long-term stability. As a result, both buyers and sellers become vulnerable to sudden market shifts, often without even realizing it. In hindsight, it becomes clear that the calm before the storm was not natural. It was manufactured by a combination of economic policy, human behavior, and collective optimism. The environment seemed safe, but it was vulnerable. Small perturbations, which under normal circumstances might have been manageable, had the potential to trigger far-reaching consequences. And that is exactly what began to happen. The early tremors of a correction were forming, almost imperceptible to the casual observer, yet significant enough to set the stage for the dramatic changes to come. In this chapter, the goal is clear: to understand that what looks stable can be deceptive. The seemingly unshakable market was quietly accumulating risks, waiting for a catalyst that would reveal the true nature of the system. Recognizing these early signs is essential for anyone who wants to navigate the coming correction with awareness, preparedness, and the ability to act before complacency turns into regret. Every market correction has a trigger, a catalyst that transforms latent risks into visible consequences. In real estate, this trigger rarely appears suddenly. It builds quietly, often in economic data, policy shifts, or market sentiment, until the pressure becomes too great to ignore. For years, property values had been climbing steadily, fueled by low borrowing costs, high demand, and a sense of unshakable confidence. But beneath the surface, the market had been accumulating vulnerabilities that would eventually ignite the correction. One of the most powerful catalysts lies in the cost of borrowing. When interest rates remain low, loans are cheap, and buyers can stretch their budgets further than they otherwise could. This keeps demand high and prices rising. However, even modest increases in interest rates can drastically change affordability, especially for those already operating at the edge of their financial limits. As borrowing costs rise, fewer buyers can qualify for loans, and those who can often face significantly higher monthly payments. Suddenly, properties that seemed attainable begin to feel out of reach, and demand softens. This is one of the earliest triggers for a market slowdown, yet it often goes unnoticed until its effects become widespread. Inflation is another factor that quietly erodes market stability. When the cost of living rises, households must allocate more of their income to daily expenses, leaving less available for housing. At the same time, developers and builders face higher costs for materials and labor, which can slow new construction and reduce supply. While this might seem to stabilize the market by limiting supply, it can also exacerbate volatility. Investors who borrowed heavily during the boom may find their returns shrinking, leading some to sell properties to cover costs, which increases inventory and further pressures prices. The interplay between inflation, borrowing, and market psychology can set off a chain reaction that rapidly accelerates a correction. Another hidden trigger comes from market sentiment itself. Confidence drives markets in both directions. When buyers believe prices will continue to rise indefinitely, they take on more risk, stretching budgets and making aggressive investments. Conversely, when a sense of uncertainty enters the market, perhaps sparked by news reports, expert warnings, or early signs of declining sales, even cautious buyers pause. This hesitation can create a sudden drop in demand, catching sellers off guard and amplifying price declines. Once momentum shifts, what might have been a minor slowdown transforms into a full-fledged correction. Additionally, supply and demand imbalances play a crucial role. In many areas, housing had become concentrated in high-demand locations, leaving limited options for buyers elsewhere. This concentration magnifies price swings. If a small segment of the market slows, it can disproportionately impact overall pricing trends. Over-leveraged investors, relying on constant growth, may react by liquidating properties, flooding the market, and creating downward pressure. The correction, therefore, is not caused by a single factor, but by the convergence of multiple triggers acting simultaneously. Finally, it is essential to understand that corrections are not inherently negative. They are part of the natural cycle of markets. They serve as a mechanism for realigning prices with economic realities. However, the timing and scale of these corrections often surprise people. What begins as a subtle shift in borrowing costs, inflation, or market sentiment can quickly evolve into a broad market correction, affecting both buyers and sellers alike. Those who recognize these triggers early have the opportunity to adjust their strategies, mitigate risk, and even capitalize on emerging opportunities before the majority realizes the magnitude of the change. In conclusion, the real estate correction did not emerge randomly. It was ignited by a series of interrelated triggers: rising borrowing costs, inflation pressures, shifting buyer sentiment, and imbalances in supply and demand. Each factor alone might have been manageable, but together they created a tipping point. Understanding these triggers is critical for anyone seeking to navigate the market intelligently, avoid costly mistakes, and position themselves advantageously as the correction unfolds. When a market correction begins, it is easy to underestimate its magnitude. Many people assume that a slowdown or price drop will be minor, a temporary pause before growth resumes. Yet, real estate corrections often unfold on a scale far larger than casual observers anticipate. What makes this correction particularly significant is not a single factor, but the combination of accumulated vulnerabilities, systemic pressures, and delayed reactions from buyers, sellers, and investors. Understanding the scale is critical to recognizing its impact on wealth, decision-making, and long-term financial security. One reason this correction is larger than most expect is the sheer accumulation of risk over time. For years, property values have risen steadily, creating a sense of invulnerability. Borrowers stretched their budgets to capitalize on growth. Investors leveraged properties for quick gains, and developers focused on high-demand areas while ignoring underlying demographic shifts. While these practices worked in a rising market, they created a fragile foundation. Once, even a small trigger, higher borrowing costs, inflation, or declining demand, appeared, the accumulated pressure magnified its effect. Small cracks turned into visible fractures, and minor disruptions snowballed into a correction of unprecedented reach. Another factor contributing to the scale is market interconnection. Real estate does not exist in isolation. It is influenced by broader economic forces, consumer confidence, and investment patterns. When multiple sectors experience stress simultaneously, the impact on property values becomes amplified. For instance, changes in lending policies can reduce the pool of buyers, while inflation affects household budgets, slowing demand across regions. Even markets that previously appeared insulated can feel the ripple effects. These interconnected pressures mean that what begins as a regional slowdown can quickly evolve into a widespread adjustment, affecting property owners far beyond the initial epicenter. The speed of the correction also catches many off guard. Real estate is often perceived as slow-moving and stable, leading buyers and investors to believe they have time to adjust. However, corrections can accelerate when confidence shifts collectively. And once buyers hesitate, sellers face declining offers and may lower prices to stimulate activity. Investors relying on continuous growth may sell multiple properties simultaneously, flooding the market and driving further declines. What might have been a gradual adjustment transforms into a rapid cascade, creating a sense of panic for those unprepared. This is why many people view this correction as bigger than they think. It progresses faster than intuition predicts. Psychological factors further magnify the correction's scale. Humans are wired to follow trends and herd behavior. When a handful of informed participants begin acting on early signals, others observe and imitate, sometimes without fully understanding the rationale. This collective response intensifies market movement. Buyers postpone decisions, fearing overpayment. Sellers adjust prices downward to attract interest. Investors reconsider strategies in response to perceived risk. What begins as a rational response to market shifts evolves into an amplified chain reaction, expanding the correction far beyond the initial trigger. Finally, long-term structural changes contribute to the size of this correction. Demographics, urbanization trends, income growth, and affordability challenges have been evolving for years. These shifts mean that the market is not merely adjusting prices temporarily, it is realigning with the realities of supply, demand, and financial capacity. For many homeowners and investors, this recalibration may feel extreme precisely because it has been a long time since such a realignment occurred. The scale is magnified by years of accumulation, creating a correction that is both deep and wide-reaching. In conclusion, this real estate correction is bigger than most people anticipate because of the convergence of multiple forces: accumulated financial risk, interconnected economic pressures, rapid psychological reactions, and long-term structural changes. What appears on the surface as a slowdown or price adjustment is actually a profound recalibration of the market, affecting buyers, sellers, and investors alike. Recognizing the scale is essential for anyone seeking to navigate this period wisely, make informed decisions, and avoid the mistakes that unprepared participants are likely to make. While many people focus on falling prices or the apparent opportunities during a real estate correction, there are numerous hidden risks that often go unnoticed. These risks are subtle, yet they can have profound consequences for anyone involved in the market, from first-time buyers to experienced investors. Ignoring them can turn what seems like a promising opportunity into a costly mistake, which is why understanding the unseen dangers is as important as recognizing the market correction itself. One of the most overlooked risks is the misconception that a dip is always safe to buy into. Many buyers assume that a decrease in property prices automatically represents a bargain, but price alone does not guarantee security. The market may continue to adjust downward for months or even years, leaving new buyers overleveraged and financially strained. Those who act solely on the perception of lower prices without considering broader economic trends or affordability may find themselves trapped in a property that continues to lose value. Timing, patience, and strategic planning are crucial to avoid falling victim to this hidden trap. Overleveraging is another danger that frequently goes unnoticed. Investors and buyers who rely heavily on borrowed funds are particularly vulnerable during corrections. A small decline in property value can have an outsized impact on someone who has stretched their finances to purchase multiple properties. Mortgage payments, maintenance costs, and other obligations remain constant even if the property loses value. In some cases, owners are forced to sell at a loss to meet financial commitments, turning a temporary downturn into a permanent setback. The risk is often invisible at first, but the consequences can be devastating if not anticipated. Market psychology also contributes to hidden risks. Real estate corrections are accompanied by fear, uncertainty, and indecision, which can cause even careful buyers and sellers to make poor choices. Panic selling, rushed purchases, and reactionary investment decisions are common. People who fail to recognize the emotional impact of a correction may allow fear to dictate their actions, leading to financial errors that compound the effects of the market downturn. Awareness of these psychological pressures is essential for navigating the correction strategically rather than reactively. Another subtle risk lies in the assumption that all properties are equally affected by a correction. In reality, variations in location, property type, and quality create significant differences in performance. Properties in less desirable areas, or with structural or legal complications, can experience sharper declines than high-demand, well-maintained assets. Buyers who do not conduct thorough research or consider these nuances may overestimate the safety of their investment. Understanding the micro-level differences in the market is crucial for making informed decisions during turbulent times. Liquidity is another hidden factor often overlooked. While the broader market may show declining prices, selling a property quickly may be challenging. In a slowdown, potential buyers may be hesitant to commit, leading to extended selling timelines or the necessity of lowering prices further to attract interest. This illiquidity can create financial strain, especially for investors who rely on cash flow or need to free up funds for other opportunities. Those unprepared for delayed sales may find themselves caught in situations that erode financial stability. Finally, long-term financial planning is at risk if people fail to adjust their strategies during a correction. Many homeowners and investors continue to operate as if the market will maintain the pace of prior growth. Ignoring affordability, debt management, and risk mitigation strategies can result in significant losses over time. Hidden risks are not always immediately apparent, but they compound over months and years, making early recognition and proactive planning critical for navigating the correction safely. In conclusion, the hidden risks of a real estate correction extend far beyond falling prices. Misjudging timing, over-leveraging, succumbing to market psychology, ignoring property-specific factors, underestimating liquidity challenges, and failing to adjust long-term planning are all dangers that can quietly undermine financial security. Awareness of these risks empowers buyers, investors, and homeowners to make informed choices, avoid common pitfalls, and approach the market with a mindset designed for resilience rather than reaction. Recognizing what most people miss is key to surviving and even thriving during this period of uncertainty. A real estate correction can be intimidating, but it also presents opportunities for those who understand how to navigate it strategically. While many view a declining market as purely a threat, the reality is that it offers a chance to protect your finances, make smarter decisions, and even capitalize on favorable conditions, if approached with discipline, knowledge, and patience. This chapter explores practical strategies to safeguard your wealth and position yourself advantageously during the correction. The first and most critical step is assessing your financial foundation. This involves reviewing your current debt, savings, and cash flow to ensure you can weather fluctuations in property values and market volatility. Over-leveraging or stretching beyond your means is one of the primary mistakes that exacerbate losses during a correction. By understanding exactly what you can afford without compromising your financial stability, you create a buffer that allows for thoughtful decision-making rather than reactive panic. This preparation provides both protection and flexibility when opportunities arise. Next, focus on long-term value over short-term speculation. While falling prices may tempt buyers to chase the bottom, predicting the exact nadir of the market is nearly impossible. Instead, identify properties that offer strong fundamentals, good location, quality construction, and sustainable demand. These assets are more likely to retain or regain value over time, even in a volatile environment. Prioritizing long-term security reduces risk, while still allowing you to benefit from market corrections, as these properties often outperform others once the market stabilizes. Diversification is another essential strategy. Relying entirely on a single property or market segment can leave you exposed to localized downturns or sector-specific risks. By spreading investments across different types of properties, locations, or even asset classes, you mitigate potential losses and increase the likelihood of benefiting from varying trends. Diversification also allows for more flexibility. Some segments may decline while others remain stable or grow, balancing overall performance. Maintaining liquidity is equally important. Having cash reserves enables you to act decisively when opportunities present themselves, such as acquiring undervalued properties or investing in necessary renovations that increase long-term value. Liquidity also provides a safety net if you face unexpected expenses or temporary income disruptions. In a market correction, the ability to deploy capital efficiently often separates those who thrive from those who struggle. Understanding and leveraging market psychology can also provide a competitive edge. Most participants in a correction act emotionally, reacting to fear, uncertainty, and panic. By staying rational and disciplined, you can avoid common pitfalls such as selling under pressure or making impulsive purchases. Recognize the patterns of buyer and seller behavior, and use that insight to make informed decisions that others might overlook. Timing, patience, and a calm approach can turn market volatility into opportunity. Lastly, adopt a mindset of continuous learning and adaptability. Markets evolve, and strategies that work in one environment may fail in another. Stay informed about economic indicators, policy changes, and broader market trends to anticipate potential shifts. Seek guidance from credible sources, analyze data objectively, and adjust your approach as conditions change. A flexible mindset ensures that you are not only protected, but also positioned to capitalize on opportunities that emerge unexpectedly. In conclusion, surviving and thriving during a real estate correction is a matter of preparation, prudence, and perspective. By assessing your finances, prioritizing long-term value, diversifying, maintaining liquidity, understanding market psychology, and remaining adaptable, you can protect your wealth and even profit while others panic. Corrections are not merely periods of loss. They are natural market cycles that reward those who act thoughtfully and strategically. The key is to remain disciplined, informed, and patient, turning uncertainty into an advantage rather than a source of fear.